No bad vibes, don't come around with that energy. They once fried, they more family than some kin to me. They show me love, still watch out for my enemies. Leveled up to the max, but I ain't hit my peak. Money in the world in my hands. 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 Money in the world in my hands.
Oh my goodness!
I see you doing your thing. Everything they say you can't. You got it going your way. Show it like, what can I say? I see you doing your thing. Everything they say you can't. You got it going your way. Show it like, what can I say? I see you doing your thing. Everything they say you can't. You got it going your way. Show it like, what can I say? I see you doing your thing. Everything they say you can't. You got it going your way. Show it like, what can I say? I ain't gotta say much. You shouldn't have to say much. Stay down so you came up, then came down and stayed up all night to the morning. Baggy eyes and you yawning, but the money keeps on calling, and we ain't about to ignore it, no. You go, you go, you go, till you got anything, then you some more. Like you on a hockey team, hit them goals. Money coming fast while you sipping slow. And me, I'm so past words, I just hit the code. Nothing funny, being broke is a joke. Get into it like it's all a nigga know. Mad I'm busy, but matter if I was broke. Yeah. And I show, so I ain't gotta say much. And you shouldn't have to say much. I see you doing your thing. Everything they say you can't. You got it going your way. So it like, what can I say? I see you doing your thing. Everything they say you can't. You got it going your way. So it like, what can I say? I see you doing your thing. Everything they say you can't. You got it going your way. So it like, what can I say?
Man, I'm definitely gonna have to change it and excuse me, put, I know it's 2.5 minutes, but I need just a little longer. Anyway, what's going on? This is part 2 of modern money mechanics. Basically reading the Federal Reserve Guide or manual, whatever you want to call it. So 3 different subjects in this one, or 3 different small topics. First one, what limits the amount of money banks can create? If, as we know, we basically create the money for the banks. They can create as much as they want, but they need us to create it. So, what limits the amount of money banks can create? If deposit money can be created so easily, what is it to prevent banks from making too much, more than sufficient to keep the nation's productive resources fully employed without price inflation? Like its I can't pronounce this word. Predecessor, on demand, a considerable amount of currency and funds on deposit with the central bank. The bank must be prepared to convert deposit money into currency. Now we remember what currency is. Currency is the paper money that we carry on us, on our person, or, that's circulating in the public. Paper money and coins. That is what currency is. And that's it. It's nothing else. Just paper money and coins that we carry on in the public. Let's see. So the bank must be prepared to convert the deposit money into currency for those depositors who request currency. And of course, again, we are the depositors. It must make remittance on checks written by depositors and presented for payment by other banks. Settle adverse clearings. So that line right there is one of the golden lines if you've been following either some of the things that I've been doing or other people, which we are using remittance coupons or checks, which are the ones that come with it looks like a check. It's at the bottom of your bills, like a credit card bill, utility bill, whatever kind of bill that you have, that you get paper. You get it on paper, and they ask you to send this back with the payment. And you got check numbers, of course, and it just looks like a check. So that's what that is. So yeah, basically it's saying that you can take it into the bank and they're supposed to give you dollar for dollar. Finally, it must maintain legally required reserves in the form of vault cash and or balances at its Federal Reserve Bank equal to a prescribed percentage of its deposits. Okay. The public's demand for currency varies greatly, but generally follows a seasonal pattern that is quite predictable. The effects on bank funds of these variations and the amount of currency held by the public usually are offset by the central bank, which replaces the reserves absorbed by currency withdrawals from banks. Just how this is done will be explained later on in this manual. For all books taken together, there is no net drain of funds through clearings. A check drawn on one bank normally will be deposited to the credit of another account. If not in the same bank, then in another bank. See how they do. They can be real dirty. These operating needs influence the minimum amount of reserves an individual bank will hold voluntarily. However, as long as this minimum amount is less than what is legally required, operating needs are of relatively minor importance as a restraint on a deposit expansion in the banking system. Such expansion cannot continue beyond the point where the amount of reserves that all banks have is just sufficient to satisfy legal requirements under our fractional reserve system. For example, if reserves of 20% were required, deposits could expand only until they were 5 times as large as reserves. Reserves of $10 million could support deposits of $50 million. The lower the percentage requirement, the greater the deposit expansion that can be supported by each additional reserve dollar. Thus, the legal reserve ratio together with the dollar amount of bank reserves are the factors that set the upper limit to money creation. So, what are bank reserves? Currency held in bank vaults may be counted as legal reserves, as well as deposits, which are reserve balances, also known as, at the Federal Reserve Banks. Now, if you seen the last video, you would know that this one came from the Federal Reserve Bank of Chicago. My bank. Anyway, a bank can always obtain reserve balances by sending currency to its reserve bank and can obtain currency by drawing on its reserve balance, because either can be used to support a much larger volume of deposit liabilities of banks. Currency in circulation and reserve balances together are often referred to as highway-powered money or the monetary base. Reserve balances in vault cash in banks, however, are not counted as part of the money held by, money stock held by the public. Even though the public are the ones who help make it, but for individual banks, reserve accounts are also serve as working balances. And footnote 2 on that, I do want to read that. The footnote, part of an individual bank's reserve account may represent its reserve balance used to meet its reserve requirements, while another part may be its required clearing balance on which earnings credits are generated to pay for Federal Reserve Bank services. Who the hell said that we wanted to go in and pay for your bank services? We already get charged. Can't use our damn FDIC insurance. Anyway, banks may increase the balances in their reserve accounts by depositing checks and proceeds from electric fund transfers as well as currency. So they can trade our our money, our currency, our dollar bills, our coins, and anything else that we deposit into a bank account. They can take it and go put more money in their account with that. If you see if you get where I'm going with this. Your currency is crazy. Or they may draw down these balances by writing checks on them or by authorizing a debt to them in payment for currency, customers' checks, or other fund transfers. So that just says that they will basically authorize, and they do this by you giving them your signature and you not being able to fully transact on your own. So, yeah, they're able to do what the hell they want to do. This is crazy. Although reserve accounts are used as working balances, each bank must maintain, on the average, for a relevant reserve maintenance period, reserve balances at the reserve bank and vault cash, which together are equal to its required reserves, as determined by the amount of its deposits in the reserve computation period. Where do bank reserves come from? Increases or decreases in bank reserves can result from a number of factors discussed later in this booklet. From the standpoint of money creation, however, the essential point is that the reserves of banks are, for the most part, liabilities of the Federal Reserve banks, and net changes in them are largely determined by actions of the Federal Reserve System. Thus, the Federal Reserve, through its ability to vary both the total volume of reserves and the required ratio of reserves to deposit liabilities, influences banks' decisions with respect to their assets and deposits. Ooh, assets is a big word when it comes to banks. I like that word. Excuse me. One of the major responsibilities of Federal Reserve System is to provide the total amount of reserves consistent with the monetary needs of the economy at reasonably stable prices. Such actions take into consideration, of course, any changes in the pace at which money is being used and changes in the public's demands for cash balances. The reader should be mindful that deposits and reserves tend to expand simultaneously, and that the Federal Reserve's control often is exerted through the marketplace, as individual banks find it either cheaper or more expensive to obtain their required reserves, depending on the willingness of the Fed to support the current rate of credit and deposit expansion. While an individual bank can obtain reserves by bidding them away from other banks, this cannot be done by the banking system as a whole, except for reserves borrowed temporarily from the Federal Reserve's discount window. As is shown later, interesting, the supply of reserves in the banking system is controlled by the Federal Reserve. Moreover, a given increase in bank reserves is necessarily accompanied by an expansion in money equal to the theoretical potential based on the required ratio of reserves to deposit. What happens to the quantity of money? If the quantity of money will vary depending upon the reactions of banks and the public. A number of slippages may occur. What amount of reserves will be drained into the public's currency holdings? To what extent will the increase in total reserves remain unused as excess reserves? Excuse me. How much money will be absorbed by deposits or other liabilities not defined as money, but against which banks might also have to hold as reserves? How sensitive are the banks to policy actions of the central bank? The significance of these questions will be discussed later in this booklet. The answers indicate why changes in the money supply may be different than expected or may respond to policy action only after considerable time has elapsed. In the succeeding pages, the effects of various transactions on the quantity of money are described and illustrated. The basic working tool is the T account, which provides a simple means of tracing step by step the effects of these transactions on both the asset and liability sides of the bank balance sheet. Changes in asset items are entered on the left half of the T sheet and changes in liabilities on the right half. For any transaction, of course, there must be at least two entries in order to maintain equality of assets and liabilities. I can't wait till we get to assets and liabilities because we are basically liabilities and the banks are the assets, but we're the ones who are supplying the credit to the banks. So technically they're the liabilities. So what we want to do is get to that status to where we make the banks once again a liability and we, remain on the asset side because we are the one who are supplying the assets. We're the ones supplying credit to the banks, to the country in general. So it's possible to get on the other side and make them work for you or work with you. Contract their ass like they contract you every time you open a bank account. Every time you sign your name on something, you're entering into a contract. So you want to be able to get to the point to where you can't do anything. You can't even do business. You can't get pulled over. You can't do, take a phone call or get some mail delivered to your house or be harassed by a bill collector. You want to get to the point to where you give people an option to, if you feel like bothering me right now, this is my fee because I don't deal with this stuff. I don't like being bothered, whatever the case may be. Here's my fee for you sending me all this letter. Here's a fee for me going to court. Here's a fee for me. You want to give me a ticket, officer. Just contract with them like they contract with you. And that's where you want to get to. So that's why we're going to go through this whole manual and grab all this juicy information. See the next one, bank deposits and how they expand or contract. This is going to be good. I really want to breathe. Yeah. You know what? I'm going to go ahead and do it. Bank deposits and how they expand or contract. We're going to get out into it. Fuck it. It's really bothering me. Let's assume that expansion in the money stock is desired by the Federal Reserve to achieve its policy objectives. On the way the central bank can initiate such an expansion is through purchases of securities in the open market. Payment for the securities adds to bank reserves. Such purchases and sales are called open market operations. How do open market purchases add to bank reserves? This is where I'm interested because this is where I'm at. I'm in my process. This is where I'm trying to get to. How do open market purchases add to bank reserves and deposits? Suppose the Federal Reserve System, through its trading desk at Federal Reserve Bank of New York, buys $10,000 of Treasury bills from a dealer in U.S. government securities. So I see a number 3 footnote. Dollar amounts used in the various illustrations do not necessarily bear any resemblance to actual transactions. For example, open market operations typically are conducted with many dealers and in amounts totaling several $billions. Whew. And we in debt. Why? Again? Again? In today's world of computerized financial transactions, the Federal Reserve Bank pays for the securities with an electronic check drawn on itself. So the Federal Reserve Bank is drawing checks on itself. Interesting. Indeed, many transactions today are accomplished through an electronic transfer of funds between accounts rather than through issuance of a paper check. Apart from the timing of posting, the accounting entries are the same, whether a transfer is made with a paper check or electronically. The term check, therefore, is used for both types of transfers. Via its Fedwire transfer network, get you one. Yeah, I'll get you one of them accounts. Sign up. The Federal Reserve notifies the dealers the designated Bank A that payment for the security should be credited to deposited in the dealer's account at Bank A. At the same time, Bank A's reserve account at the Federal Reserve is credited for the amount of the securities purchased. The Federal Reserve System has added $10,000 of securities to its assets, which it has paid for, in effect by creating a liability on itself in the form of bank reserve balances. These reserve banks on Bank A's books are matched by $10,000 of the dealer's deposits that did not exist before. And it says see illustration 1. So let's go down. Deposit expansion. Okay. So when the Federal Reserve Bank purchases government securities backed by reserve increase, this happens because the seller of the securities receives payment through a credit to a designated deposit account at a bank, which would be Bank A, which the Federal Reserve effects by crediting the reserve account of Bank A. So here we have Federal Reserve Bank assets. U.S. government $10,000 plus $10,000. The liability, they made themselves a liability on this reserve account. Excuse me. That account, which was Bank A, plus $10,000. Now let's go on Bank A side. You have reverses with they reverse the Bank A reserve account with Federal Reserve account, the bank. Now you see the 10,000. Boom, boom. Now you have your liability side over here on the customer's deposit, 10,000. And see, this is how it's supposed to be, but it's not for us. But it is supposed to be. And this is what you want to get to. You want to get to be able to have your account set up like this so that your unlimited credits can transact just like this. While I'm talking, I got some paperwork I need to send to for one of my banks. I'm going to go ahead and fax it, and I can upload it online. That's fine. Yeah, so you want to get your pass-through accounts. Have to. Extremely important. Get your pass-through accounts. How the multiple expansion process works. If the process ended here, there will be no multiple expansion. An example, deposits and bank reserves would have changed by the same amount. However, banks are required to maintain reserves equal to only a fraction of their deposits. This is how they rob you. Reserves, a fraction. Reserves in excess of this amount may be used to increase earning assets. So all the money that they don't tell you that you really got, they use it, take it to their excess account, and then they add it to their assets. Loans, let's see, let me go back. Reserves in excess of the amount may be used to increase earning assets, loans, and investments. Unused or excess reserves earn no interest under current regulations. The reserve requirement against most transaction accounts is 10%. Now see footnote 5. For each bank, the reserve requirement is 3% on a specified base amount of transaction accounts and 10% on the amount above this base. Initially, the Monetary Control Act set this base amount called the low reserve tranche. Can't pronounce that. That's how I'm going to pronounce it. Half of this stuff shouldn't even pronounce the way it is, but hey. At $25 million and provided for it to change annually in line with the growth in transaction deposits nationally. The low reserve tranche was $41.4 million in 1991 and $42.2 million in 1992. I can only imagine. The Garment-Saint-Germain or Garment Act of 1982 further modified these requirements by exempting the first $2 million of reservable liabilities from reserve requirements. Wow. Like the low reserve tranche, the exempt level is adjusted each year to reflect growth in reversible liabilities. The exempt level was $3.4 million in 1991 and $3.6 million in 1992. That's crazy. I can only imagine how much it is now. And I wonder what I'm going to have to look this up. How much are they exempt from now in 2023? Because in 92, well, let's see, the act of modify these requirements. So maybe I need to see if the act has been modified since 1980, since whenever it was last modified. I don't know when it was. Let me see. Oh, no, damn. So I need to look up what the exempt level was. It is currently. So in 92 was $3.6 million. So let's see how much banks are exempt from, keep reporting basically, or how much they have to keep of the deposits. This is crazy. I'm assuming the simplicity of uniform 10% reserve requirement against all transaction deposits, and further assuming that all banks attempt to remain fully invested, we can now trace the process of expansion in deposits, which can take place on the basis of the additional reserves provided by the Federal Reserve System's purchase of U.S. government securities. What's crazy is that same 10% is the same 10% of all of our earnings that we actually get to keep. That 90% goes to everything else but us. We are allowed to have our 10% of our yearly earnings or lifetime earnings out of every checks, everything. We get 10% of our checks. We get 10% benefits when we, need them. We get 10% of the money, we should be getting, or, the money we made when it's time to retire. Whatever went in that fund, we basically get 10% of that. There's so much more in there, honestly, but we only get 10%. They take 90% of your lively earnings. They take they take 90% of your hard labor. 90%. Just like we only use 10% of our brain. Why? Because they control the rest. So this is a lot. It's a lot. It's a lot of scamming going on. So let me go back to 10%. So the expansion process may or may not begin with Bank A, depending on what the dealer does with the money received from the sale of securities. If the dealer immediately writes checks for $10,000 and all of them are deposited in other banks, Bank A loses both deposits and reserves and shows no net charge as a result of the system's open market purchase. However, other banks have received them. Most likely, a part of the initial deposit will remain with Bank A, and a part will be shifted to other banks as the dealer's checks clears. It does not really matter where the money is at any given time. The important fact is that these deposits do not disappear. They're in some deposit accounts at all times. all banks together have $10,000 deposits in reserves, and they did not have before. However, they are not required to keep 10,000 reserves against the $10,000 of deposits. All they need to retain under a 10% reserve requirement is $1,000. So $10,000, they can only account. They're only going to put on their books for 1,000, even though you created 10, or you helped them create the 10. This amount can be loaned or invested. The remaining $9,000 is excess reserves that can be loaned or invested. And let's see, illustration 2. So as a result, all banks taken together now have excess reserves on which deposit expansion can take place. So total reserves gained from new deposits, $10,000. Required at 10%, required against those new deposits is only 1,000. So look how much they get to keep. 9 whole thousand. You can't make this shit up. You just can't. You just can't. This is the beginning of the deposit expansion process. And I may stop it. I'm thinking. Sorry. Okay, so this is the beginning of the deposit expansion process. In the first stage of the process, total loans and deposits of the banks rise by an amount equal to the excess reserves existing before any loans were made. 90% of the initial deposit increase. At the end of stage 1, deposits have risen a total of $19,000. The initial $10,000 provided by the Federal Reserve's action, plus the $9,000 in deposits created by stage 1 banks. So we'll see illustration 4. No, we didn't even hit 3. Let's hit 3 real quick. Expansion takes place only if the banks that hold the excess reserves. So stage 1 banks increase. You have your assets at loan, a $9,000 loan, and borrow deposit $9,000. So someone deposited $9,000 into their account. The bank matched that $9,000 and they would have kept out of the $9,000. Okay, they would have kept what would it be? $8,100. They would have kept 9 on the books and would have pocketed the rest. That's what you call some shiesty shit. Why do these banks stop increasing the loans and deposit when they still have excess reserves? That's the thing. So start telling these banks about their excess reserves. I know you got them. You know, let's not be crazy now. You have excess reserves. That's just crazy. They only have to report 10% of their earnings or money deposited. Oh, that's crazy. Whether stage 1 banks actually do lose the deposits to other banks, or whether any or all of the borrowers' checks are redeposited in these same banks, makes no difference in expansion. So they can redeposit checks. They redeposited checks, y'all. You can't make this shit up. You can't make it up. Banks are depositing checks more than once. The same fucking check. But they want you to avoid your shit. Oh, no. This is shit that makes me mad. It make me mad. Okay. I don't even want to see no more illustrations. If the lending banks expect to lose these deposits and in equal amounts of reserves as the borrower's checks are paid, they will not lend more than their excess reserve. No, they did not. No, they did not. Oh, like the let me finish this because this is like the original $10,000 deposit. The loan created deposits may be transferred to other banks, but they remain somewhere in the banking system. Whichever banks receive them also acquire equal amounts of reserves, of which all but 10% will be excess. Money just floating around. Your money. Assuming that the banks holding the $9,000 of deposits created in stage 1 in turn make loans equal to their excess reserves, then loans and deposits will rise by a further $8,100 in the second stage of expansion. Ooh, this process can continue until deposits have risen to the point where all the reserves provided by the initial purchase of government securities by the Federal Reserve System are just sufficient to satisfy reserve requirements against the newly created deposits. The individual bank, of course, is not concerned as to the stages of expansion in which it may be participating. Inflows and outflows of deposits occur continuously. Any deposit received is new money, regardless of its ultimate source. Its source, even if it's wrong. But if bank policy is to make loans and investments equal to whatever reserves are in excess of legal requirements, the expansion process will be carried on. And I want to see what all is left. Yeah. Yeah, so that's crazy. So I will stop it at here. Or I'll finish this one off. How much can deposits expand in the banking system? The total amount of expansion that can take place is illustrated on page 11. Carry through the theoretical limits. The initial $10,000 of reserves distributed within the banking system gives rise to an expansion of $90,000 in bank credit, loans, and investments. Ooh. And supports a total of $100,000 in new deposits. Under a 10% reserve requirement, the deposit expansion factor for a given. Wow. I'm just in shock. Dirty motherfuckers. Amount of new reserves is thus the reciprocal of the required reserve percentage. 10%. Loan expansion will be less by the amount of the initial injection. The multiple expansion is possible because the banks as a group are like one large bank in which checks drawn against borrowers' deposits result in credits to accounts of other depositors with no net change in total reserves. They take money and they take the money that you put into the bank and they make more money. Just that's how it works. Whatever you put in the bank, they make more off of it. That's people. Expansion through bank investments. Deposit expansion can proceed from investments as well as loans. Suppose that the demand for loans at some stage 1 banks is slack. These banks would then probably purchase securities. If the sellers of the securities were customers, the banks would make payment by crediting the customer's transaction accounts. Deposit liabilities would rise just as if loans had been made. More likely, these banks would purchase the securities through dealers, paying for them with checks on themselves or on their reserve accounts. These checks would be deposited into the seller's banks. In either case, the net effects on the banking system are identical with those resulting from loan operations. Yeah, can't make this shit up. This shit's crazy. This is what the banks do. This is what they do. So I will be doing part 3. Maybe not tonight, depends on how I feel. If I do, I'll pre-record and set these to go live once again. So yeah, that's how I may do it. This stuff just drains me. All the bullshit that they put you through with their nonsense is just outrageous. And I just really want people to kind of make this a priority to know and understand. Because a lot of people out here really do put trust in these banks, but don't know that my check got deposited into my account. So my bank just took my check and created money from my check. Money that I will never see. Money that I will never get to spend in my lifetime. Because I'm out here slaving. But you create this to tell me that I need to use this. Use your service to hold my money. When my money don't mean shit, all my money is, and my signature is a gateway for you to make all the money that you want. And it never stops. Your transaction account. Your transaction account. Get your transaction account. That's all I'm going to say. See you guys later, part 3.
No bad vibes. No bad vibes. Don't come around with that energy. They once vibe, they more family than some kin to me. They show me love, still watch out for my enemies. Leveled up to the max, but I ain't my peak. Money in the world in my hands. 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 Money in the world in my hands.
Oh my
I
goodness!
see you doing your thing. Everything they say you can't. You got it going your way. Show it like what more can I say? I see you doing your thing. Everything they say you can't. You got it going your way. Show it like what more can I say?
I see you doing your thing. Everything they say you can't. You got it going your way. Show it like what more can I say? I see you doing your thing. Everything they say you can't. You got it going your way. Show it like what more can I say? I ain't gotta say much. You shouldn't have to say much. Stay down so you came up, then came down and stayed up all night to the morning. Baggy eyes and you yawning, but the money keeps on calling, and we ain't about to ignore it. No. You go, you go, you go, till you got anything, then you some more. Like you on a hockey team, hit them goals. Money coming fast while you sipping slow. And me, I'm so past words, I just hit the code. Nothing funny, being broke is a joke. Get into it like it's all a nigga know. Mad I'm busy, but matter if I was broke. Yeah. And I show, so I ain't gotta say much. And you shouldn't have to say much.
I see you doing